Hello everyone. We're going to look at chapter 14 in these PowerPoint slides. Our first delving into business entity taxation. We've talked about business taxation with regard to Schedule C and sole proprietorship, but chapters after this are going to deal with actual business entities. So these are the ones that we're going to deal with. We're going to talk about C corporations in this chapter 14 and these other three in chapter 15 because they're treated the same and on a federal tax level. And chapter 16 will deal with S corporations, which are much more like partnerships in taxation than they are like C corporations in terms of taxes. Very similar in terms of C and S corps are pretty much the same when it comes to liability protection, but not tax-wise. So historically, that you could be a C corporation even by accident if you acted too much like it, but IRS stopped doing that and allowed companies, businesses to basically decide how they were going to be taxed as long as they're consistent. Okay, some things that come up with regard, this is not new, accrual method, cash method, hybrid method, although hybrid method is generally only talked about with corporations, but it can apply to any of them. There you go, have the different ways. Corporations are forced as they get bigger to be accrual method much earlier than other business entities, the C corporations are. But for the most part, you can choose. A lot of companies do choose the hybrid method, which allows you to do cost of goods sold and things like that, but then have cash basis for your other expenses. But that again is a choice that, and choosing one and moving from one to the other is just like any other entity. This is where we start to get to the things that are different, okay, than what we're used to in our income formula or our taxable income formula for individuals. Now we're talking about corporations. C corporations have a separate taxable entity. They calculate their income and pay the taxes on that income separately from the shareholders. So gross income, revenue minus cost of goods sold equals gross profit. Then you take your other deductions, except for these special. All of these are handled special for corporations. Then charitable, then dividends received deduction, all right, then the DPA deduction, which domestic production activities deduction and carrybacks, and then the NOLs and short-term capital losses. So you need to go in this order. All other deductions other than these special ones go at once, and then you have these others that are done in that particular order as long as they apply. Okay, one thing you need to remember is that there is no capital gain special tax rate for corporations. They pay, capital gains are treated the same as ordinary income. There's no real need to differentiate between the two, which simplifies their lives, but also doesn't have that benefit that comes with individuals paying at a lower rate. And they can only use capital losses to offset capital gains. No $3,000 capital loss can be deducted or anything like that. So if you have capital losses that exceed the capital gains, you have to either carry them back or carry them forward. And notice that the limit is 3 years back and 5 years forward. And anything you carry either direction is short term. So your example, you got your short term, long term. Remember, we did this the same thing with individuals. We put all the short terms in one basket, all long term in one basket as far as how long they are owned. Okay. You offset the losses against the gains and you end up with excess capital losses. Those are all short term. They go back 3 years or forward 5. Organizational costs are another one that kind of limited to corporations, or at least they're going to be more substantial with a corporation because it usually takes a little bit more legal costs to organize a corporation. But they can deduct up to $5,000. There's a limit, okay, organizational costs in a tax year. The rest is going to be amortized, okay, over 180 months. And they start to get reduced when your total organizational costs exceed $50,000. All right? So example, we pay $40,000, we get in business on November 1st, we can deduct, it doesn't go over 50, so we can deduct $5,000 now, the other $35,000 over 180 months. Now we've gone over $50,000, so we have to reduce the amount we can deduct. So we can only deduct $1,000 now out of our 54. The other 53 go over 180 months. Okay, so it was reduced because of the excess over 50,000. All right. Startup costs are those things that happen before you get started. The point being, as soon as you get the business started, as soon as you have a little bit of revenue, as soon as you can sell something, your business is in business and you don't have to worry about this limitation. So you want to get started as quickly as possible. But if you have advertising, if you have various investigation costs that happen before the business starts, that's what startup costs are, and they have a very similar thing as organizational costs. Rule is basically, and they're separate. So organizational costs, you got $5,000. Startup costs $5,000. $5,000, but reduced if it's over 50, 180 months. So everything over by one, that means we reduce the amount we can deduct by 1,000 down to 4,000. The remaining 47 is 180 months. All right, that brings us, that was just one of the deductions here under the deductions that is kind of different. Well, two of them, startup costs and organizational costs, that we hadn't really talked about previously. All right, charitable contributions. This works differently than we're used to with individuals. All right, because corporations can only deduct up to 10% of their income prior to that. So we take this taxable income for figuring the CC, and 10% of that is all we can deduct for this charitable contribution deduction. Meaning if you're losing money, you can't make charitable contributions and have them deductible this year. If you don't use them, if you made contributions over 10%, they get carried over the next 5 years. No carry back, only carry forward. But then they will be subject to the 10% taxable implication again. Okay, so it doesn't go away. It just happens each year, and then after 5 years, they disappear. So you can only use them for 5 years. Okay, $30,000 taxable income, $200,000 before the other special deductions. Deduction is $20,000, carries over the other $10,000 for 5 years. All right. Dividends received deduction. This is another special deduction for corporations that's based on receiving dividends from another company, okay, from another corporation. So a C corporation receives dividends from another corporation, but the amount of their percentage is based on how much you own. If it's less than 20, then your DRD percentage is 70. Between 20 and 80, it's 80. And if you own from 80 to 100, then 100% DRD percentage. What does this DRD percentage mean? That means you're going to deduct that percentage of the dividends. Now, the key thing to remember when you're calculating this or working with an example is you must add the dividends to the regular income and then take the dividends received deduction. All right? So it is a two-step process. Don't forget to add in the dividends and then take it as a deduction. So you add in the dividends at 100%, you take a deduction for 70%. So the end result is for this level is you end up paying tax on 30%, if you will. So example, 15% outstanding shares, we receive a $100,000 dividend from Jackson. Dividends received deduction is 70%. That's the, remember on our slide, less than 20% is 70. Okay, we're less than 20, so at 70%, 70,000. Now, there's some limits on this, okay, or some quirks, you might say. When ownership is less than 80%, so I mean we're not at the 100% thing. We still have taxable income after subtracting the DRD. Okay, the DRD is the lesser of the standard percentage, which is 70, 80, or 100, 70 or 80 in this case, times the dividend received, or taxable income before the DRD. Okay, so it's the lesser of these two. All right, so that's the thing you need to remember. If our income is kind of on the low side, we may have this be our DRD instead of this. So let's look at that. Well, receives a $10,000 dividend from Killian. Symbol taxable income before the DRD is $5,000, so pretty low taxable income. 65% is in 80%, right? Okay, it's standard percentage. So if we use the 80% of 10,000, that would be 8,000. Now, this still gets applied because the DRD results in a loss. Thus, the taxable income limitation does not apply. So if we do the dividend times the standard percentage and it results in a loss, and when we take the deduction, remember 5,000 minus 8,000 would be a loss, then we go ahead and use the 8,000. If it doesn't result in a loss, then we may have to see if the amount is limited by taxable income. So this is the example we're going to see now. 20%, okay, all right, so standard percentage, 20% is into the 80% level. 32,000, 40,000 times 80% is 32. We subtract that from 35. That does not result in a loss. So we have to do the next step and compare it, okay? We take the lesser, take the taxable income times 80%. So the dividends was 40%. Taxable income before the DRD is 35. It's 28,000. So it's either 32 or 28, whatever is lower. Okay, so again, if it's a loss, you go ahead and use the standard percentage of the dividends no matter what. If it is not a loss, then you may have to use the percentage of the income if it is lower than the percentage of the dividends. Okay. Net operating losses, similar to individuals, back 2 years, forward 20 years. And you can elect to forego the carryback. Corporations file 1120. Due date is 3.5 months, April 15th now for C corporations, except if there's June 30th year end, you only get 2.5 months. Quirk in the tax law as that's written. Okay, get an extension, 5 months, I'm sorry, or if it's June 30th, 6 months. Well, except for June 30th is 6 months. And for June 30th, 7 months. So that June 30th, kind of crazy. All right, now I want you to make a careful note of the fact that taxable income of the corporation, C corporation, is taxed at different rates based on the amount. It is not a flat 35%, 39%, 34%, anything. It is on the first 50,000 is 15%, next 25%. So remember that when we ask you to calculate the tax on a corporation. All right, you're going to have to schedule it out like this. All right. You just need estimated payments. Otherwise, we'll do that. Corporate distributions. I have a separate podcast about corporate distributions, but you should review these. Basically, if there is money, earning and profits in the corporation, you treat it as dividends, then tax-free return of capital, then capital gain, in that order. So first of all, any distribution from E&P gets taxed as dividends, and after that it's return of the capital, meaning you're paying them back for their stock, and then after that is corporate capital gain. Property, the key thing to remember is appreciated property distributed. The corporation recognizes the gain for the amount of the appreciation. If there is a loss, there is no loss recognized. So only the gain is recognized. That would increase your earnings and profits. Okay? So make sure that you understand, and also the fair market value is the amount of distribution, and that becomes the shareholders' basis in that property distributed. And here's your example. Okay? And then this example with a loss. No loss, but you still distribute at fair market value. And that is the end of C Corporation.